Know when we're in a bull or bear market. I'd love to see gold back at 3,500. If it gets down to this, I think that this will be like the last opportunity before it starts the next big rally, which could be $7,000, $8,000, $10,000. Silver has got this scenario, Elijah, like gold, that it's rallied up and it is creating this long bull flag pattern as well. So if silver does start to move up and starts to break some of these resistance levels, silver could at that point continue to go to 200. I do believe the economy is very close in the stock market to a big sell-off, which will drag gold and silver down for this huge opportunity. It could be the last time in some people's life cycle to be able to pick up gold before it screams higher and doubles again. Silver has a similar type of price action. It's had this huge euphoric move. It's consolidating. And if we were to use Fibonacci based on silver, it's got a bit different price action. It is showing that we can go all the way down to about $40 an ounce in silver. So we could see a big correction in silver. And if silver was to wipe out down to this price range, it would be a crazy, I mean, there's definitely a few ways to play gold. It really depends on the individual, right? If you're an individual looking at the long-term picture, you think, the dollar's going to collapse and all hell is going to break loose. And, there's always going to be inflation and devaluation of currencies. If you're just a long-term holder, you got lots of time. I mean, you can just buy and hold metals. I think long-term it will be great. You're right. We have been navigating this as more an active an investor. We ended up getting out of gold right around 5,200, somewhere in here. We also moved out of silver right at 113 when the markets were screaming, saying, hey, this is where the momentum is shifting. We saw all this unfolding. So we did exit at a very good point there. And now the markets are trying to correct. And so where we stand in terms of investors, when we look at this chart of gold, and we'll just zoom back a little bit more, right across here was a very significant move. Gold and silver were moving as that defensive play. And then this whole phase right here, we saw gold really break out, and this is where silver as well, we saw it become the crowded play. This is where it became a euphoric move, and everybody was just buying it, and people who've never been in metals before were piling into metals. This was an exciting run. I mean, I was a big holder of precious metals since 2019, since the new super cycle in gold started.
The biggest risk often hides inside the moment everyone feels smartest. As Chris Vermeulen points out here, the shift from defensive allocation to crowded trade is where most retail investors unknowingly buy the top. When gold and silver turn into everyone's trade, it's no longer about fundamentals like inflation or currency debasement. It's about momentum exhaustion. We saw similar behavior in late 2020 and again during peak liquidity phases, where late entrants drove prices beyond sustainable levels. Smart money exits quietly into that enthusiasm, while long-term holders confuse conviction with timing. Next, Chris Vermeulen discusses how past cycles reveal what usually comes after this kind of euphoria.
So if we were to just zoom back, let me just let this chart load here. So if we zoom back on gold, 2019 is where the last super cycle for gold kicked in, which is right here. This was the breakout for gold. So I've been holding it there. I also bought some on the 2020 sell-off, both gold and silver. And so now we've come up to this peak, this euphoric type of top, which, believe it or not, actually looks a lot like what we saw in 2011. And silver is almost the identical chart of how it's not only moved, but how the pattern that's unfolding. And so while I don't think we're going to go into a 10-year sideways market, I think we're still potentially have a bit more of a pullback in precious metals. Now, this doesn't look like much in gold, so I'll just zoom back so we can go back to gold in 2008, but we saw gold and silver pull back. We saw gold pull back about 34%. We saw silver pull back over 60%. And I believe we're going to see, we've started this. And so if we were to fast forward to where we are today, I think we're going to see gold potentially, based on Fibonacci, which is one of my favorite measuring tools, I think we could see gold. The downside target for gold is about 3,500. Now, This to me is a really good sign. This is a measured move. This is where gold technically, from a chart standpoint and momentum and all of that, is pointing to as the next support level. And if you notice on this chart, this is also right where it went into a euphoric feeding frenzy. And the market is great at hurting the majority of people who chase pricing. And this whole blue box from here to here is where people chased and drove the markets higher. And it has a great way of coming all the way down and trying to shake out those short-term, fear-driven, the FOMO-driven traders who want to make money like everyone else. The market has a good way of doing that. And so I'm very, very excited to see this because I'd love to see gold back at 3,500. I think it'll be, if it gets down to this, I think this could be one of the last this will be like the last opportunity before it starts the next big rally, which could be $7,000, $8,000, $10,000 over the next, decade or so, however long it's going to take. So I like this. There's a lot of people that don't want this because they just want it to keep going higher. But this to me would be the most bullish scenario. This would be a measured move, an unwinding, a correction within a massive cycle to the upside. And then from here, it's going to go a whole lot higher. Now there's another scenario for silver. Both of either one of these could happen is we've had this giant run up and now we've got this bull flag.
Markets don't punish weakness. They punish emotional chasing at the wrong time. As Chris Vermeulen points out here, historical drawdowns of 34% in gold and over 60% in silver aren't anomalies. They're part of the cycle most investors ignore. The uncomfortable truth is that a drop to 3,500 isn't bearish, is structurally healthy, resetting positioning after euphoric excess. Wall Street rarely highlights that major bull markets require brutal shakeouts to continue higher. Investors focused only on upside targets like $10,000 often miss the path dependency that destroys portfolios in between. Next, Chris Vermeulen unravels what this potential correction could mean for timing the next major entry.
This is known, if this market consolidates and starts to actually show signs, it could just continue to go a whole lot higher. And then we go up to that, $7,000, $8,000, $10,000 mark sooner than later. But either way, you just need to know when to move in, when to move out of precious metals and follow the price charts, which is what I do. So right now I'm looking and hoping for a bigger correction. I do believe the economy is very close in the stock market to a big sell-off, which will drag gold and silver down for this, I think, kind of huge opportunity. I'd say once in a lifetime, but this cycle happens a few times in somebody's life cycle. So it could be the last time in some people's life cycle to be able to pick up gold before it screams higher and doubles again. So let's go take a look at silver real quick, because I think silver has a similar type of price action. It's had this huge euphoric move. It's consolidating. And if we were to use Fibonacci based on silver, because it hasn't fully, it's got a bit different price action. Instead of taking this recent one, it's actually, we can draw all the way from here. It is showing that we can go all the way down to about $40 an ounce in silver, which everybody is thinking is, insanely cheap.
The real opportunity often arrives disguised as a broad market sell-off nobody wants to touch. As Chris Vermeulen points out here, a potential drop in equities dragging metals lower isn't a failure of gold. It's a liquidity event where everything gets sold. This is where most investors panic, even though history shows major entries come during cross-asset declines, like 2008 or March 2020. The idea of silver revisiting $40 sounds extreme, only because recent price action has conditioned expectations higher. Timing, not conviction alone, determines returns in these cycles. Next, Chris Vermeulen discusses how silver's structure could offer one of the most overlooked entry points.
That it'll never get back down to that level. But that was also when everybody was saying silver's headed to $200 an ounce. And so when you have the mass majority of people not wanting something and they don't believe in it, usually that's going to happen. And so we could see a big correction in silver. And if silver was to wipe out down to this price range, it would be a great opportunity. Now, there's let's just take this other scenario as well. We can do the similar one as gold. We got this sell-off. We've got this bear flag, and it comes down to about 42. So the low 40s, if silver was to correct with the stock market and the economy. We see the US dollar take off, which is the dollar is getting primed and ready for a huge rally. It is going to hit silver very, very hard. And then silver down in this range is going to be like, back the truck up. This will be the time to pick up, either stack more metals, or in my situation, this is where I'll be re-entering and repurchasing a ton of metals to go forward, physical metals, just to store probably for the next 5, 10, 15 years. A very long-term position.
When everyone agrees something can't happen, that's usually when the market is setting up to do exactly that. As Chris Vermeulen points out here, sentiment extremes like calls for $200 silver often mark tops, not beginnings. A move back to the low 40s isn't collapse, it's mean reversion fueled by a stronger dollar and tightening liquidity conditions. This is the part Wall Street avoids explaining. Strong dollar cycles historically pressure commodities hard, regardless of long-term bullish narratives. Investors who understand this prepare cash, while others get trapped averaging down too early. Next, Chris Vermeulen shows how positioning during this phase separates long-term winners from emotional participants.
And so, again, silver has got this scenario, Elijah, like gold, that it's rallied up and it is creating this long bull flag pattern as well. So if silver does start to move up and starts to break some of these resistance levels, silver could at that point continue to go to 200. So that's what I'm looking for. My biggest fear when it comes to precious metals or any investment really is wasting time. And so let's just zoom back just so we can get this scenario here of what I do and why I do it. Now, what I focus on is this type of euphoric move is actually very similar to what we saw over here. And again, it took like 14 years to break out to new highs. I don't want to get stuck holding metals for that if we enter that. The other scenario is we are right here, and it's going to be a very short-lived sell-off, and then we're going to see the next huge opportunity. So silver could have a further correction here and then start to really, really take off. So those are kind of I think the two scenarios that are going to happen is we're either see silver start to break out, generate a new buy signal and say, okay, we can get back into silver.
A breakout sounds exciting, but time is the hidden cost most investors ignore. As Chris Vermeulen points out here, the real danger isn't just price decline. It's capital being locked for years in sideways markets like the 2011 to 2024 stretch. A 14-year wait to break even destroys compounding, especially when inflation quietly erodes purchasing power. The bull flag scenario may look bullish, but it assumes liquidity stays supportive, which depends heavily on Fed policy shifts and rate cycles beyond 2026. Investors chasing $200 silver need to ask whether they're prepared for dead money phases first. Next, Chris Vermeulen shows how timing decisions separate opportunity from stagnation.
We should have imminent return. It should start to take off, or we're going to continue to see it consolidate, find a bottom, start to turn up, and then we can invest in it when it's way undervalued and is a great long-term position to double, triple, quadruple returns from this level again. So that's the scenario. Most investors obviously don't know when to move in, when to move out of equities. That's what I specialize in. Precious metals is what I've been doing since pretty much 2001. I got into it, really focused on it hardcore since early 2007. And so I live and breathe this space and I fully believe in it. I'm a gold bug, but I can also sell my gold when I know I'm getting a really good premium for it, and I can reinvest, purchase more gold later when I believe it's going to have quick returns, or I can buy it at a discounted price.
Conviction without timing discipline is how long-term investors quietly underperform. As Chris Vermeulen points out here, knowing when to step aside is just as important as knowing when to buy. Yet most portfolios stay fully exposed regardless of conditions. The promise of double or triple returns only works if entry points align with undervaluation, not emotional attachment to assets like gold. Since 2001, metals have delivered cycles, not straight-line gains, often tied to liquidity waves and Fed easing phases like 2008 and 2020. Investors who recycle capital outperform those who simply hold through every phase. Next, Chris Vermeulen discusses how positioning shifts when markets broadly turn against investors.
And if you're an active investor like yourself, what do you suggest for people? It seems like a lot of things might be taking a hit, right? If the dollar rallies, the stock market, metals, all of that. So how do you invest when so many markets are falling?
Yeah, that's the big problem with like advisors, like money managers, is they have to keep money in the markets. And unfortunately, when everything goes down, there really isn't anywhere to go. That's why all the buy and hold portfolios and money managers who have to stay invested lose money. They watch everybody's accounts go down. As an individual investor, we can just step back and say, hey, I don't want to own anything. I think there's a couple ways to take advantage of it. One of them is, the simplest one is, know when we're in a bull or bear market. When we enter a bear market, just put your money in cash somewhere like where you're going to earn interest without any downside risk. So you can buy like an ETF like BIL. You could put it in a high interest savings account. You could just totally sidestep it, earn interest and make money while everybody else loses their shirts.
The biggest myth in investing is that you always need to be invested to win. As Chris Vermeulen points out here, institutional constraints force money managers to stay exposed even during clear downturns, which is why portfolios bleed during bear markets. Sitting in cash isn't laziness. It's a strategic decision, especially when short-term yields remain elevated above 4 to 5% in tightening cycles. Wall Street rarely promotes this because inactivity doesn't generate fees. For individual investors, avoiding losses can outperform chasing gains during downturns. Next, Chris Vermeulen shows how to actively profit when markets fall instead of just preserving capital.
Or you can play an inverse ETF. So if the markets fall, your account goes up in value. That's something that I do. I do both of these. We move to cash at times. We'll buy inverse ETFs for short windows to catch drops as the market collapses. And the other play would be potentially to move into a currency. Obviously, if your money is already in the US dollar, you kind of already hold the dollar. But as an international trader myself, you may want to move into an ETF like UUP or USDN or USDU, I think, is another ETF. So if you're an American and you have US dollars, you can actually still take advantage with an ETF for the rise of the US dollar index. And again, I just mentioned there's like 10 to 20% upside in just holding a currency, the US dollar currency ETF, which is a pretty darn good return if the stock market is to fall, 30 to 50%. So there's three ways to take advantage of it. And we kind of navigate all of them. We dance around and play all of those because each one may actually have a different signal at a different time. And that's what we do.
Profits don't always come from growth. Sometimes they come from positioning against decline. As Chris Vermeulen points out here, inverse ETFs and currency plays are tactical tools designed for specific market phases, not long-term holds. A 10 to 20% gain from dollar strength may sound modest, but compared to a 30 to 50% equity drawdown, it's significant relative outperformance. The overlooked risk is timing. These instruments require precision, as prolonged holding can erode returns through volatility decay. Most retail investors aren't taught how to use these tools effectively, leaving them exposed during downturns.